Later this morning, the Senate Banking Committee is going to be looking into the failures of Silicon Valley and Signature Bank's former SVB CEO Greg Becker, former Signature Bank Chairman Scott Shea, and former Signature Bank President Eric Howell will be answering questions about what went wrong at their institutions. Joining us right now to talk more about that hearing, Ohio Senator J.D. Vance. He's a member of the Banking Committee. And good morning to you, Senator. Let's talk about it. What are you trying to find out from them, and how much is it, in your mind, a problem of what took place at those banks specifically versus policy and maybe the supervisors?
Well, I think clearly these guys were way overexposed to long-term interest rates. That's what happened with Silicon Valley Bank, and I think to a lesser extent Signature Bank. But to me, what I'd like to understand, because we're looking at clawbacks legislation here at the Senate Banking Committee, whether we should basically take some of the money that these CEOs paid themselves out as their banks failed and try to get some of that back, especially because taxpayers are implicitly picking up the tab here. So question number one for me for Silicon Valley Bank's Greg Becker is going to be, look, you paid yourself a $3.5 million bonus 2 weeks before your bank failed. Did you know at the time that the bank was in serious trouble? And if you didn't know, what the hell were you doing?
You just talked about the idea of clawbacks. And the big question in this context is, my understanding is that you also talked about taxpayer funds. This really is the FDIC that's managed this thus far. How do you square that circle?
Yeah, so here's the basic problem, right? So the FDIC pays for these uninsured depositors. That's the way that Marty and others at the FDIC have set up the system. But that FDIC fund is paid for by regional and community banks. And, of course, that is borne by our taxpayers in the form of higher fees at thousands of banks all across our country. So, yeah, it's going to be borne by taxpayers, not directly, but this will see an increase in the basic costs of banking by our small businesses, by our middle-class families all across the country.
Of course it gets passed on to the customers, but I would think that the way the FDIC works, it's an insurance program. It's about as sort of free market a system as you could have. The question is, where's the government's role or not on the clawback side of this?
Well, I think the basic argument is you cannot have these CEOs who run their banks into the ground but benefit personally in the process. I don't think that's a free market system. I think a true system, the good thing about a free market system is accountability, that you suffer consequences for screwing things up. And there's clearly been a failure here when these banks are able to pay the CEOs large sums of money or have the banks offload a ton of stock right before the bank effectively crashes into the mountain. That's a serious
Senator,
problem. And again, it's something that I think creates risk in our banking system.
But the question is it the role of government to do it, or is it the role of shareholders, debt holders to effectively sue what's left of the company or the individuals directly, civilly, for the money back?
Well, look, I'm happy for the shareholders to sue, but I also think it's our job to provide some proper oversight here. And we know, we all know here that shareholders have relatively limited options after these banks have been run into the ground. I think it's important for us to do something proactive here and make it clear to the CEOs while they're making these decisions. If you turn your bank into a disaster zone, you're not going to get a fat paycheck from it. If you turn your bank into a successful enterprise, by all means, pay yourself a fat bonus, but not if you run your bank into the ground.
Senator, where do you land on the idea of deposit guarantees? Effectively, whether it's codified in law or not, we have implicitly, if not almost explicitly, guaranteed depositors their money. Is that, and then you also people talk about personal responsibility. Where the two ideas land?
Well, look, I think most people, when they're banking at a bank, they don't think that they're lending the bank a ton of money. But, of course, that's how it works in our system. I really think that we need to have federal deposit guarantees. We need to make sure that people don't get completely hosed when you have a bank collapse. The problem is that we need to have that proactively, not reactively. The problem that I have with how the FDIC handled Silicon Valley Bank and Signature is that they effectively changed the rules in the middle of the game. If we're going to have FDIC insurance, and we should, it should be clear about where the rules are, where the lines are. We can't change those things and increase the implied deposit guarantee in the middle of a bank panic. I actually think that makes things worse. It adds risk to the system if people assume that the Fed is going to step in, the FDIC is going to step in and guarantee every uninsured deposit. That uncertainty and that implied assumption of risk is a big driver, I think, what's going on in the banking system today.
Senator, there's been a lot of conjecture that maybe regulators dropped the ball. They were there. They even knew about the mismatched liabilities. It was the San Francisco Fed to some extent, and they've had, I don't know whether you have an opinion on this, but a lot of the recent papers emanating from the Fed out there has been managing climate risk. A lot of bragging about managing climate risk. Is that factor into? I mean, it would have been good to manage liability risk for the Fed in this case. I think. I mean, by the time we are at zero carbon, none of these people are going to have jobs at Silicon Valley. They may be living in a real clean environment, but they have no jobs at this point.
Yeah, you're exactly right. So the San Francisco Fed really fell asleep at the wheel. I think a basic examiner test would have went into Silicon Valley Bank, realized their balance sheet was a disaster. It's frankly shocking that the San Francisco Fed didn't realize what was happening as this whole thing was unfolding. But it also raises some difficult questions about the revolving door in our banking system. Of course, Greg Banker sat on the board of the San Francisco Fed. He's the CEO of SVB. We need to have some division between the regulators and the entities that they're regulating. But absolutely, the regulators fell asleep at the wheel here. This is a catastrophic outcome. It's something the San Francisco Fed should have seen very clearly very early on, and they didn't. And that's a problem.